Hello everyone, Professor Christensen here. Today we're going to review an exercise that covers some adjusting entries. I know that adjusting entries are often a topic that cause problems for students. So here is exercise 314 from your book. If you are looking at this video and don't have the book, if you're not in my class, let me just see if I can make this a little smaller. You could take a picture of this, and that is the data that we're going to use. All right. Okay. So here is our information. Remember that adjusting entries happen at the end of the year. Let's say the end of the period. Sometimes we do them at the end of the quarter. So here is our information at December 31st. We have a trial balance, and I did add some extra lines in the trial balance just because I know what we have to do as we go along here. We have a trial balance that shows the numbers that resulted from all of our regular transactions during the year. Then they give us some information at the end of the year, 4 different pieces of information. So our goal here is going to be to prepare journal entries to record these 4 adjustments. And then we're going to prepare an adjusted trial balance. So we're going to turn our current trial balance into an adjusted trial balance. All right, so let's go. First, letter A tells us the balance of prepaid rent, $7,200, represents payment on October 31st, 2018 for rent from November 1st, 2018 to April 30th, 2019. All right, this is tricky. I always tell students, watch your dates, watch your rates in adjusting entries. And here we have some dates, okay? So I'm going to make this a little bigger so you can see it better. Okay. So what did they do? They paid $7,200, and that's going to cover them from November 1st to April 30th. So that means November, December, January, February, March, and April. So this is payment for 6 months. All right. So over here, let's do a little calculation. We have $7,200, and that covers 6 months. All right. So divide 7,200 by 6, and you find out that that means it costs $1,200 per month. All right. Okay, so we pay $1,200 per month in rent. Now we need to figure out how much we have to adjust. We still have $7,200 in our trial balance, but we paid the rent for November and December, but that's been used up now. So 2 months have passed, all of November and all of December. So 1,200, turned red, that's okay. 1,200 times 2 gives us 2,400 used up. Okay? So what do we call used up? We call used up rent expense. So we're going to debit rent expense for $2,400. Remember that every adjusting entry affects one income statement account and one balance sheet account. So let's put in here IS for income statement. All right? Now, what is our credit going to be? Well, we're showing $7,200 in prepaid rent, but we've used up $2,400 of it, so we don't want our prepaid rent to be $7,200 anymore. We have to credit our prepaid rent. We're going to indent our credit to bring it down by the amount that we used. Okay? So let's put a note here. Amount used is how much you adjust your rent for. Prepaid rent, prepaid insurance, supplies all work the same way. Okay? All right, so now let's mark over here. We're going to fix our adjusted trial. We're going to turn this into an adjusted trial balance. So we're going to make a little note. We're going to add rent expense, $2,400. And we're going to reduce our prepaid rent by $2,400. Okay? All right, and we'll fix those numbers later. Next up, balance of deferred revenue, $3,000, represents payment in advance from a customer. By the end of the year, $750 of the services have been provided. All right, so let's recall, what is deferred revenue? It means that a customer came and paid you for services that you have not yet provided. All right, think about buying tickets, season tickets, for any kind of sports team. right? You paid the money, but the sports team hasn't earned the revenue yet. All right, so as time goes on and we provide services, then we're going to have to make an adjustment. So basically, they're saying 750 of the services have been provided. That means that revenue is no longer deferred, it's been earned. Okay? So we're going to debit deferred revenue. It is a liability. By the way, that's a balance sheet account for 750 because it's no longer deferred, right? Then we're going to credit service revenue. That's an income statement account. Let's go up here and remind ourselves that prepaid rent is an asset. That's a balance sheet account. Okay, so 750. Okay, so this is the amount earned. Okay, amount earned. All right, so our deferred revenue is going down by 750. Our revenue is going up by 750. All right. Okay, next up. An additional $700 in salaries is owed to employees at the end of the year, but will not be paid until January 4th, 2019. All right, so almost every company, unless they happen to have a pay period that ends on the last day of the period, the company is going to have some salaries that need to be paid to their employees at the end of the year. So in this case, we have $700 in salaries that we owe our employees. This is called an accrual, the accrual entry that we're going to make. Okay, these two had to do with deferrals. This is an accrual. So what are we going to do? We owe employee salaries. So let's start with that part. What do we call owing employee salaries? Salaries payable. Salaries payable is a liability account which goes on our balance sheet. All right. So what is the other half of this entry? It's going to be salaries expense. That's an income statement account. Okay, 700, 700. All right, so our salaries expense is going to go up by 700, and we're going to add to salaries payable plus 700. Okay. All right, the last one here. This one's a little bit more complicated. They actually give you more information than you need, but let's walk through the details here. The balance of supplies, $4,000, here it is on our trial balance, represents the amount of office supplies on hand at the beginning of the year, $1,700, plus an additional $2,300 purchased through 2018. By the end of 2018, only $800 of supplies remains. All right, so let's put that information here into our supplies account. What are they saying? At the beginning of the year, we had $1,700 on hand. All right, we purchased $2,300. So that gives us a balance of $4,000. That's our unadjusted balance. Okay, our unadjusted balance. All right, now what are they telling us? So this is the number that's on our trial balance up here, remember. Okay, what are they telling us now? At the end of 2018, only $800 of supplies remains. So that means our adjusted balance should be $800, right? We only have $800 worth of stuff left, so we can't have a balance sheet that's showing $4,000 when we really only have $800 of stuff. So what do we have to do? We have to bring this account down from $4,000 to $800. So we're going to credit our supplies for $3,200. And what do we call supplies that we used up? Supplies expense. Again, oops, that's an income statement account. Supplies is a balance sheet account. Okay. All right. So we're going to add supplies expense plus 3,200, and we're going to reduce our supplies by 3,200. So we're going to have a minus 3,200 for our supplies. Whoops, that's strange. I don't know what happened here. Oh my, Okay, we're just going to say that's going to be a minus 3,200. We'll fix it. There we go. Okay, so let's finish this up now. All right, so those are all of our adjusting entries. And remember what happens. So let's just review real quick. We have normal transactions, right, that happen every day. Then we get to the end of the month. We have to do adjusting entries to take care of all the revenue and expense accounts that are different than what's showing on our unadjusted trial balance. Once we do our adjusting entries, we post them, and then we're going to do a new trial balance, an adjusted trial balance. So just for simplicity purposes, I'm going to turn this trial balance into an adjusted trial balance. Now, remember, no adjusting entries affect cash. So we know that our cash is not going to change, right? And we have here all of our notes that we're going to change to fix up our accounts. All right, so our prepaid rent is showing at $7,200. It should be equal to $7,200 minus $2,400, okay, or $4,800. Our supplies were $4,000. We know they're supposed to be $800 now. Our deferred revenue used to be $3,000, but we know that $750 of that was earned, so that's no longer deferred. So that's equal to $3,000 minus $750. We're going to add in salaries payable, which is also a liability, right? We put the liabilities in order. Remember, we have assets, liabilities, equity, revenue, and expense on our trial balance in that order, okay? All right, now we're going to add in our service revenue. So our service revenue is equal to 51.2, which is what we had before, plus 750. Our salaries expense is going to be 35,000 plus 700, so 35,700. We're going to add in our rent expense of 2,400. We're going to add in our supplies expense of 3,200. Let me fix these up and get them so that they're not underlined. And okay. Oh, never mind. We'll just leave that alone. Let me take out these underlines, though, because only the last one should be underlined. We don't want to get confused. Okay, there we go. All right. And notice that our totals here, because this is a sum of everything. So our totals are showing that our adjusted trial balance is balanced. Okay, we'll call these totals. All right, so that's our adjusted trial balance. All right, so that's a little bit of an adjusting entries problem. I hope you find this helpful to your studies. Have a great day.